Welcome to Business Sense Financial Reporting, created and designed by SHB Consulting Services and The Training Factor. A strong understanding of financial statements will assist you in your job and set you apart from others. Finance is the language of executives. Learning to speak the financial language can give you a real competitive edge. In this session, you will learn to use financial statements as a management tool to run your day-to-day operations. You will learn how to speak the language of your owner, and you will gain understanding into your owner's needs. There are several types of financial statements, but we will only focus on the two major statements. The first statement we will cover is the balance sheet. The next statement we will cover is the statement of operations. The balance sheet is a financial statement that summarizes the company's assets, liabilities, and owner's equity at a specific point in time. It is also called a statement of financial position because it highlights a company's worth. This statement is one of the most important pieces of financial information because it is a snapshot of what is currently owned and what is currently owed at that particular point in time. The balance sheet's basic equation is assets equals liabilities plus owner's equity. This is an example of a very simple, condensed, comparative balance sheet. The balance sheet was formatted to compare balances at the beginning of the year to balances at mid-year. We will discuss the components of a balance sheet and then some specific balance sheet accounts. The first division of a balance sheet is assets. Assets are what is owned. Assets are listed on the balance sheet in order of liquidity. Being liquid means the asset can be sold rapidly with minimal loss of value any time within market hours. Current assets are more liquid than long-term assets. Current assets are assets that are expected to be sold or otherwise used up within 1 year. Examples of current assets are cash, escrows, and rent receivables. Long-term assets are those assets on the balance sheet that will be in service for more than 1 year. Examples of long-term assets are fixed assets, deferred assets, and certain other assets. Liabilities are what is owed. Current liabilities are those liabilities which are reasonably expected to be liquidated within a year. Examples of current liabilities are accounts payable and accrued liabilities such as real estate taxes payable and mortgage interest payable. Long-term liabilities are those liabilities which are reasonably expected not to be liquidated within a year. An example of a long-term liability is mortgage payable. Equity is the difference in what is owned and what is owed. It is the net worth. Equity is expressed in various forms depending on type of ownership. In our examples, retained earnings is what was earned or lost in prior years, and current year profit or loss is the earnings or loss from this year's operations. This is an example of the equity section of a balance sheet. The statement of operations is also referred to as the income statement, the operating statement, the statement of operations, the P&L, or the profit and loss statement. This report reflects activity over a specific period of time, as opposed to the balance sheet, which represents a single moment in time. A statement of operations summarizes income and expenses through both operating and non-operating activities. It also highlights the net profit or net loss incurred. The statement of operations is used to determine past performance, to help predict future performance, and to assess the ability to generate future cash flows. The difference between operating income and operating expenses is net operating income. Net operating income is commonly referred to as NOI. NOI probably has more focus than any other number in property management. We will discuss the components of the income statement. Two components of the statement of operations which are not common to entities outside property management are physical occupancy and economic occupancy. Physical occupancy is calculated by dividing the number of apartments occupied by the number of apartments that are available for rent. Economic occupancy is calculated by dividing the amount of rent collected by the total amount of rent scheduled to be collected. The difference is concessions, employee allowances, and bad debt. Property management's goal is to maximize income. Economic occupancy presents a truer picture of performance than physical occupancy. If the property has 300 apartments and 285 are rented, what is your physical occupancy? You would calculate your physical occupancy by dividing the number of apartments rented, which is 285, by your total number of apartments, which is 300. 285 divided by 300 equals 0.95, which is 95%. The physical occupancy is 95%. Now you try. Read the scenario on the next slide and fill in the blank. I'm sorry, that was incorrect. Please try again. In this scenario, you have 350 apartments and 280 are rented. Your physical occupancy is 80%. That is 280 divided by 350, which equals 0.80, which you multiply by 100 to find the percent of apartments occupied, 80%. Now let's look at the economic occupancy. To move on, click the Continue button.